We're back. Concerns about the economy and the way the Trump administration has escalated its trade war, sending stocks into a meltdown lately. Is the worst almost behind us? Let's ask Ron Insana, iFi AI CEO, with me here on Post 9 on set. It's good to see you.
Good to see you.
What's your sense of what's going on here?
From a market perspective, I don't think we're quite done. I mean, this was not exactly an impressive bounce off the lows.
Yeah. A little feeble.
Yeah, I think the chaos and the uncertainty is unsettling, and you're starting to see more and more stories come out about business executives quietly are complaining but not yet publicly willing to say anything. And you're seeing a lot of disruption take place, both at the business level and, with the layoffs, somewhat indiscriminate layoffs at the government level. I don't think this is done. I think the market underappreciates the extent to which the Trump administration means all this. Everybody keeps talking about negotiating tactics or incremental steps towards a goal. I don't necessarily agree with that assessment. And so I think the markets may be underpricing the risk, both economic and geopolitical, going forward.
I mean, there's been this belief that, this is somebody who lives by watching the stock market.
Or did.
Yeah. Well, that's where I was going, is that the belief going into Trump 2.0 was the stock market was going to be critically important, just like it was the first time around. Maybe what we're learning is that agenda and policy is more important than stock performance, at least in the near term. Enough that the Treasury Secretary himself came on the air and said there was no Trump put.
Yeah.
Is that that's what you're alluding to?
Yeah, and that's what I think when you really step back and when you try to be dispassionate about this, and again, I always try to put, personal preference aside and do policy analysis. When you look at everything that's being talked about, everything that's happening, it appears to me anyway, and other people have said this, that the Trump administration is recreating the world order post-World War II, right, on a trade and economic basis and on a geopolitical and military basis. And if you look at it through that lens, then markets are not anticipating fully the types of changes we're likely to see in the next 4 years.
Let me ask you about that. Then maybe the markets weren't paying attention, because it's not like the campaign hid any of the objectives or ideals of President Trump.
Right.
So why is the market surprised?
So I think there was selective perception here, right? I mean, you look at the potential for extending tax cuts, maybe even deepening them for corporations from 21% to 15%. You look at deregulation, which if you have to spend less on compliance, that goes straight to the bottom line, a net positive. You look at the assumption that mergers and acquisitions were going to pick up, irrespective of apparently the new FTC's point of view that maybe not. We're not going to be as lenient as people thought. And then you thought there was going to be an IPO deluge that was going to come and, bring and make new riches in the AI space, which may or may not happen. So I think Wall Street focused on what would be positive for Wall Street and corporate America, but ignored all the other pieces of this that could be net negatives for the economy.
What if it's all still going to be positive? It's just on the come, and it's going to be later.
Yeah, it'll be
than
later.
People thought.
Yeah.
As I said, what Robert Kaplan sat here, and former Dallas Fed president, of course, said it's not like it's no, it's just not now.
And it's not that it's no. I mean, let's say they just extend the tax cuts, right? So what's different going forward, right? You don't get that extra kicker to growth if the corporate tax rate isn't reduced. Yes, maybe you get some kickers to growth if there's more deregulation. But again, that seems to be not quite as aggressive as people had anticipated coming into the election.
I don't know. I mean, they're still talking about it regarding the banks. I mean,
that's in one spot.
But that's a big spot.
Yeah.
When you're talking about deregulation.
Yeah.
But that's the first place you look.
And we know what happens when that happens, right? I mean, 3 to 5 years out, you have a mistake somewhere in the financial system that causes problems later on. I mean, when the Bush administration turned the other way on lending standards for residential and other types of real estate, we had a credit bubble and a real estate collapse that ensued. So I'm not a big fan of overly deregulating the financial sector. Yeah, you could see more mergers and acquisitions among regional and small-sized banks. But, how much bigger can the big banks get without increasing systemic risk?
But the other thing is, you never, as well as anybody, you've seen many more markets than me. I mean, to date you, man.
Thank you. Appreciate that. Yeah, I'll be 64 at the end of the month.
You're never going to time things perfectly. But if you can look, as we've been saying, forest through the trees, then maybe there is reason to be optimistic like people were coming into the year. You just have to get through some of this mess.
Yeah, look, I think this year's one most definitely of uncertainty, and I think it's going to be fairly chaotic for some months to come. And I'll stick with Warren Buffett's maxims that you never sell the U.S. economy short. No matter what happens, we come out stronger on the other side. I'll buy that all the time. But that doesn't mean there can't be periods of chaos. There can't be bear markets. There can't be recessions. They happen with serial regularity, and I think that risk is out there right now. I'm not convinced that this is a trading environment. In fact, I'm more convinced to a certain extent that Europe for maybe the next year or two might be a better bet.